Hello and welcome. In this lecture video, we'll be doing some quick check problems revolving around the financial statement errors related to errors in inventory accounts. And then we'll also talk about some inventory ratios, okay? So we look at this first one. Our Thelma company reported cost of goods sold for the year 1 and 2 as follows. So if you think about this, this is just, all this is we have, remember, beginning inventory plus purchases comes down to merchandise available for sale, and then that goes to ending inventory, and then to cost of goods sold. That's what's going on, right? So I have my beginning inventory plus my cost of goods purchase, cost of goods available for sale, or the cost of merchandise available for sale, the same thing. And then that goes over here to ending inventory. I subtract out ending inventory, and then I get cost of goods sold. That's how I'm getting cost of goods sold. So you can see 370 minus the 130 gives me the 240. Okay, same thing here over here with year 2. All right. So Thelma company made 2 errors. Ending inventory at the end of year 1 was understated by 15,000, and ending inventory at the end of year 2 was overstated. Given this information, what should cost of goods sold be for year 2? So let's just redo it. So we'll say year 1, and then we'll say beginning, and then purchased, and I'll say the cost of merchandise available for sale, or just MAS, merchandise available for sale, ending, and then cost of goods sold. So beginning, nothing wrong there for year 1, 120,000. Nothing to do with purchases, 250 gives us 370 right over here. And then it says ending was understated by 15,000. So this should have been 145. It's 130, but it's understated, so it should have been 145. Merchandise available for sale minus ending gives me my cost of goods sold of 225. Now I can do the same thing over here for year 2. Now what happens with year 2, right, is that this ending, look up here, ending for year 1 becomes beginning for year 2. Okay? So I have my beginning again. It's not 130 like it is up in the figure, right? Now it's 145. I see nothing with purchases changing, so it says constant at 275. I add those two together. That gives me my merchandise available for sale, 420. Now ending inventory was overstated by 6,000. So this is not be 135. Be 6,000 less, it should be our 129. So now 420 minus my 129 gives me my 291. A is the right answer. Okay, so the interesting thing is that when you make a mistake over here, right, that cascades to the next year too. Okay, so it screws up the next year. All right, so don't make mistakes in your end of period inventory accounts, otherwise you got all kinds of problems. All right, make sure that those are right as much as you can. So if we look over here, let's look at number 76. If a period and inventory account is reported in error, it can cause a misstatement in all the following except, yes, cost of goods sold. We've talked about that. If cost of goods sold is wrong, that means gross profit is wrong, because remember, gross profit is net sales minus cost of goods sold. Current assets, yes, because that could either overstate or understate your inventory count, and the count of your inventory goes into your current assets because merchandise inventory is classified as a current asset. So yes, if cost of goods sold affects gross profit, and then gross profit flows into net income, yes, it can screw up net income. What doesn't it affect? Net sales. Why? How do we calculate net sales? Do you remember? Well, if you don't remember, it's just sales minus sales discounts, returns, and allowances. That's how we calculate net sales. So, do you see anything to do, anything with inventory, does that deal with our sales numbers? No, not our sales discounts. No. It deals with the cost of goods sold and our count of inventory, our inventory balances, but not our sales, okay? So that's why C is the one it doesn't affect. Let's look at our inventory ratios right over here. So the first one is we have inventory turnover, also known as merchandise inventory turnover. Same thing. It says how many times a company turns over its inventory during the accounting period. And so this is a good indicator of how well management is controlling the amount of inventory available. If it's really low, then what that means, and if we look down at this figure, we can see how to calculate it. We take our cost of goods sold divided by our average inventory. How do we calculate the average inventory? It's beginning inventory plus ending divided by 2. So the way we calculate this ratio is cost of goods sold divided by average inventory, and average inventory is calculated by beginning inventory plus ending inventory divided by 2. Okay, that gives us our inventory turnover. When that's really low, that means cost of goods sold is a big percentage, right? That means the company is not turning over its inventory very quickly. Okay, that's what that's telling you. A low ratio is saying they're not turning over their inventory very quickly. Put this in layman's terms. They're not selling their inventory very quickly. That's what that means. And why is this a problem? Well, it means that their inventory is just, stacking up in their warehouse, which means, geez, got so much inventory, maybe we need to get a second storage unit to put all this inventory in. Well, guess what? Those storage units aren't cheap. You got to pay for that. So you're increasing your inventory holding costs by holding too much inventory, and this can tell you whether you are or you're not. This ratio gives you insight into that. If you have a really high ratio, right? A really high ratio, that means cost of goods sold is it's your average inventory is low compared to your cost of goods sold. That means this number is really high, right? That's the way that gets too high. Well, why is this a problem? Well, yeah, you're not holding a whole lot of inventory, but it may mean that your customers are saying, hey, I'd really like to buy this new Xbox. Oh, they're flying off the shelf. We don't have any more. Sorry. Well, that means you need to order some more inventory. Okay, so a high ratio is preferable, assuming we have enough inventory to meet customer demand. That's a good take-home message there. Okay, let's look at this next one. Day sales and inventory says how much inventory is available in terms of our number of days of sales. It's a good measure of our adequacy of inventory to meet our future sales, to meet future customer demand. The way we calculate that is we take our inventory divided by our cost of goods sold times 365. So this is expressed in terms of days. If this says 1 day, let's say this says 1 day, you have 1 day's worth of sales in inventory. That's what that's telling you. What do you need to do? You need to order some inventory really quick, because after tomorrow, you don't have any more inventory. That's what that's telling you. Okay? So let's take a look at how to calculate this. An example here. We had cost of goods sold, 9,421,000. Ending inventory, 2,089 million. Average inventory, 1,965 million. What is our days sales and inventory? So if we look up here at our formula, we take our ending divided by our cost of goods sold times 365. 289 divided by our 9,421 times 365 gives us 80.9 days. E is the right answer. Okay? All right. So I'm going to end this lecture video now, and then our last lecture video will cover these final practice problems for Chapter 6. Okay? Thanks so much.